Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and of course, crystal ball gazing. Today is Thursday, November 7th, 2024. Today's episode, obviously, the FOMC had their 25 basis point cut. I did not watch the speech. I will do so and give my commentary on it as soon as I get a chance to do so. Didn't have time today. Very notably, credit spreads are insanely tight right now. Going over to the Fed website, looking at the high yield index option adjusted spread between high yield treasuries and high yield bonds and U.S. treasuries, we see a spread of 2.74%. This is rare. This is like, okay, everything is like so good that we can risk our money and there's no chance of anything bad happening. That is what is being priced in right now at, I believe, the worst possible time for all of the reasons of the daily reminders. Before we get there, just another glance of this chart. 2.74. The lowest this normally gets is maybe 3%. We were in this range very briefly in 1997. We were around, we didn't quite get there in 2005 for 1 month reading of this. We got to an extreme low in May of 2007 at 2.46 before the great financial crisis, which, you know, the crises tend to happen, you know, when the market thinks that everything is just 100% honky-dory, and that's exactly what's going on here. I know many of you might think that I sound like a broken record at this point, but you know, it's a slow-moving ship, and this is a daily show. I'm going to keep saying the same things, you know. And by the way, I'm not a perma-bear. I promise I'm not a perma-bear. You might think I'm a perma-bear by watching the shows, but go back, you know, 6 months or so, and you'll see I've said with more confidence that I think, you know, markets could go up at certain times. I think right now, it's time. It's time. We're at that point. We're at the peak of the business cycle. Things are going to roll over here. My crystal ball and all, me and my crystal ball and all can see it very clearly. If you'd like to hear me read through the daily reminders, things that I think are immensely important for investors to understand, watch Monday's show. We have 2 updates in the daily reminders, being the S&P 500 PE ratio currently sitting at 31 now, yesterday being at 30, and the CAPE ratio rising to 38. This is like pre-depression kinds of numbers. Like, these valuations are extreme. They are extreme, and I'm happy to be invested the way that I am, but we'll get to it. Again, watch Monday's show to hear my full breakdown of the daily reminders. The crystal ball reading remains the S&P 500 currently priced as if it's a Ponzi scheme. And when I mean Ponzi scheme, it means that the price is relying only on other people to bid it higher. The valuation doesn't make sense. It's priced like as if it is a Ponzi scheme. It's functioning as a Ponzi scheme right now. And I am scared of what will happen moving forward for a lot of people that are stupidly invested right now, in my strong opinion. I believe there's a bear market imminent. I also believe that the Fed in this cycle won't cut fast enough to save the economy due to fiscal dominance, and cuts therefore having a muted effect. We will jump into the charts momentarily. There are some exciting things, so stick around. Before that, I just want to give a quick thank you for watching. If you enjoy my 2 cents, support with your 2 cents or a like. You support the channel any way you please. Love the support. On to the charts. We're going to start with the S&P 500. Obviously continuing higher today, comfortably still within actually this previous wedge pattern, interestingly. Very obviously, we will most definitely get to 6,000. Whether we go higher, some chartists I respect, including Gareth Soloway on Verified Investing, is convinced that we're going to hit 6,100. He says on his show he's doing $1 million put bet on SPY when we get to 6,100. He probably doesn't mean that he's buying $1 million worth of puts, by the way. If you follow his show, what he's talking about more likely is getting $1 million worth of exposure to SPY to the downside. And so depending on his strike price, and you can get that exposure for a lot less than $1 million. So I'm curious. I don't actually know if he is actually buying $1 million worth of puts, or he is actually or if he's just, getting that amount of exposure. I think he's just, doing it for the attention. I don't think he's actually buying $1 million worth of puts, but he has very strong conviction that the top will be at 6,000 he says he's mixed on it, 6,000 or 6,100. I think he's probably going to short at 6,000 in case it doesn't get up to the 6,100, but then complete the short position at the 6,100 level. I believe this marks the top of a logarithmic chart that goes back a long time, suggesting from a purely technical standpoint that could be a top with strong probability. So it'll be very cool to see how it plays out. The VIX future curve for the first time in 2 months is now completely reverted or uninverted, where the most close contract is below the rest of the contracts because time costs money. Things have gotten back to normal in the VIX, at least temporarily. I'm really not certain how long this will last, but the market, I guess people were really nervous about this election, and now they think everything's going to be fine. Yeah. If only they knew about valuations. But I digress. I've mentioned on yesterday's show, I wish that they updated the 10-year break-even inflation rate at a faster pace. Apparently they do update it for the day, and they say it updates at 4 p.m. Oh, Central Time. Oh my goodness. So really? That means that's 5 o'clock Eastern Time. Okay, I'll have to check this more frequently. Anyway, point is, the 10-year break-even inflation rate, this says what the market is currently pricing inflation to average over the next 10 years. On the day after the election, it shot up actually to 2.38, and then today we went down to actually 2.33. So just very important market to keep your eye on. It's what the market is. It's what the bond market, the smartest, biggest money out there, is betting on inflation being for the next 10 years. And of course, it can change pretty dramatically, as I've said before. In beginning of August, we were all the way down to 2.04, and then again in halfway through September, we got to 2.02% briefly. I am of the belief, by the way, if you've been showing the show, that we are going to go back down to that 2% or even below that expectation for demographics reasons and fiscal dominance, both. TLT, my favorite place to be, staying within this previously formed widening wedge after going down. This is typical of a reversal signal, suggesting that the breakout will actually be to the upside. If you follow the show, I'm highly exposed to long duration Treasury bonds. Largely at this point, I'm more confident in this than ever, especially as I see stock valuations getting so ridiculous, and yields not being ridiculously low at the same time. The valuation difference between stocks and bonds is not correct, and when it does correct, TLT should do well, and the S&P 500 should go down. I always need to take the other side and think, well, what could make it go the other way? So to play devil's advocate, we need to see earnings. We need to see earnings expansion. We need to see that companies are actually earning more and more and more money. They have not done so yet. We still haven't actually broken through highs of over a year ago in the S&P 500 as a total earnings yet. And for where we are in the business cycle and starting the cutting phase, I'm actually expecting earnings to be contracting here, which will send the PE ratio even higher. And, you know, it just makes bonds just look more and more and more attractive. But the opposite side of that, okay, if companies can prove it, you know, come out with amazing earnings and more earnings and more earnings, and then the valuations, you know, will make sense against the bonds right now. There's a major divergence. So I am, you know, yeah, I've been talking about bonds for a long time, TLT being good, and I'm more confident than I've been before, you know, with this recent drop in price. The value hasn't gone away. It's increased, actually. At a lower price, the value has actually increased, not decreased. The price has decreased, and the value has actually, therefore, gone up. With credit spreads widening, HYG finding a new high, while this is unreal. If you've been following the show for a while, you know I own long-dated puts, including leaps, put contracts on HYG on various dates. It's just a matter of time before the market wakes up to the reality that these are actually junk bonds. They're not treasuries. They're not AA bonds. These are junk bonds. They will default. Some of these companies will go out of business. It's just how it works. It really isn't rocket science. One thing that caught my eye today in the charts, U.S. Treasury yield curve, I talked about recently the 3-month dropping below the 20-year. Now the 3-month is, again, above the 20-year. Again, you know, it's more about the 2-year, 10-year, which is still now reverted, and the 3-month, 10-year, which has not reverted yet, but we are headed in that direction still. Bitcoin still looking strong here. Some suspect we're headed up to the $81,000 range is what I hear now. A lot of Bitcoin enthusiasts are convinced that we're headed to the $100,000 mark. I considered participating myself, but for where we are right now, it's too much risk for me to be able to stomach. TNX, the 10-year Treasury note yield, had broken above this major trend line that had formed a very major head and shoulders top. And why not scroll out? Why not show it? I love this chart. Going back to April of 2021, the top there, and then hitting the neckline of this head and shoulders top through the end of 2022 through 2023, broken down, retested. We had actually broken above that trend line, you know, on the election news that, you know, we had rates going up. In order for this to hold above this purple line here, we need to see a close above the wick of the election day candle. And instead of seeing that today, we went straight down. The bears drove the yields down, or, you know, the bulls on treasuries like me. We drove it down clearly below both of these other lines that I have here. So yields are not running away to the upside as it stands right now. Treasury bulls are taking charge here. I'm apparently not the only one out there that sees these guaranteed yields at these levels as pretty attractive for this duration, 10 years and further out. Next chart I'm bringing up today is oil. Can somebody text oil and let them know that, you know, we just had an election in the US and that's really important, and, you know, the price should be going like this a little bit more. Oil's not budging at all. This is amazing. It just doesn't move. It doesn't care. It doesn't care about the election. It doesn't care about yields. It doesn't care about what Powell says. It doesn't care about the Fed cuts, what's going on in China. Nothing. Oil just sitting completely flat. Amazing. Next, I want to bring up copper. I noted yesterday, the reaction day after the election, how Dr. Copper, with a PhD in economics, had collapsed. And we made that entire candle up today, basically, almost to the high. Amazing bounce back on this market. Not sure the drivers behind it. Don't care, just watching it for interest. Last few charts, SMH getting quite bullish today, but I am going to point out that today's candle does not look like, did we close? We closed basically at the open of the big engulfing red candle, suggesting to me that I believe very strongly tomorrow the bears will take control and maybe even do another one of these engulfing red candles to the downside. It would make sense for 1,001 reasons, including the overvaluation of the entire industry. Trees grow very tall, but they definitely don't grow forever. I'm not seeing the catalyst that can send this way higher. Well, I mean, what catalyst is there? I mean, maybe if Bitcoin keeps going up, then people might believe more people will invest in semiconductors to mine more Bitcoin, I guess. We'll see how it goes. I'm still holding on to SOXS, now at a slight loss, actually. I believe this is still headed down. I think this is a head and shoulders top here. I think it's bound to go down, but that's just me and my crystal ball. Last chart of the day, Nissan, I have been talking about, is the only stock worth holding right now. And it went down by 7% today. I joked around yesterday. I was saying, like, it's so undervalued. Like, what is it going to go? It's going to go to zero. Again, take a look at the balance sheet. If you were to take the book value on face value, if the company were to fully liquidate and sell all of the stuff they have, their property, their equipment, their cars, everything at the value that they say that it has, which, admittedly is higher than what you'll actually get in the market, each shareholder will get, I calculated it out, it's about $12 per share. And now we're trading at just under $5 a share. And that's why I say this is one of these Graham cigarette butt stocks. To me, I know you guys watching out there, maybe you're following Nissan because of me. And maybe you bought some Nissan because of me. And, I'm sorry about if you feel bad about the loss, but I should have bought more today. I did not buy more today because, like you, I see the price go down and I get worried, but then I sit back and I take a look at the valuation. I see that the company, if it were to liquidate right now, I would be making money. This is such a clear value play for Graham. And so if I'm going to live by, if I'm going to invest by Benjamin Graham's investment philosophy, I'm not worried at all. And I should actually be buying more right now to maintain the percentage value of my portfolio. And that's how I see it. With a full liquidating value of around $12, and a company that makes cars that I see like thousands of these Nissan cars every day, new ones, old ones. Nissan's not going anywhere, I don't think. I think it has wide moat. I think, its balance sheet is solid. It's a solid company. I mean, for it to be this low in price, I think is absolutely insane. I mean, if its liabilities at least outweighed its assets, like, for example, if you liquidated it and it wasn't able to pay off all the debt, then yeah, we'd be worried, but that's not the case. Mr. Market can do crazy things. He can send the S&P 500 to the point where it's priced like it's a Ponzi scheme, and it can price Nissan stock as if it's actually garbage when it's not. But that's just me and my crystal ball. And that's all for me and my crystal ball. Hope you enjoyed. Thank you for watching. See you next time. Rob's Child.